So I think on average, I'm starting to see valuations coming down from peak about 30, 40% at this
Okay.
point.
Peak
Um,
being last year or
yes,
yeah.
peak being beginning of last year, let's
Okay.
say. So we're already starting to see down rounds. Of course, there's a lot of creativity being applied,
Mm-hmm.
whether it's bridge rounds or uncapped safe notes with discounts or people trying to find clever ways,
Mm-hmm.
to come up with a different number. But the reality is, if you look through it, the transactions are at a lower valuation than they were. Egypt, especially, is seeing a significant number of down rounds as we speak.
Hi, everyone, and welcome to episode 51 of Conversations with Lulu with my guest Basil Moftah, who is the general partner at Nclude. Nclude is an Egyptian based venture capital firm that is investing in fintech startups across the MENA region. Prior to Nclude, Basil was a general partner at Global Ventures, and prior to that, he spent over a decade at Reuters, holding several executive roles, from being a founder member of the Reuters Venture Capital Group, investing in great companies like Yahoo, WebEx, Netscape, and more, to leading their global emerging markets unit, to being the president of the intellectual property and science business. He is an advisor and a board member to several international and regional startups. We're going to be talking about the startup ecosystem, what is happening given the global economic conditions, especially with a lens on Egypt, with a focus on Egypt. What are VCs doing to deal with the crisis at the moment, and what are resilient entrepreneurs doing to weather the storm as well? It's definitely a very interesting conversation if you're an entrepreneur or if you're related to the startup ecosystem in any way. So let's tune in. How are you?
I'm good.
You're good?
Tired, a lot of traveling,
A
but
lot
I'm
of
good.
traveling.
Yeah.
What's happening in what's new in Include?
So, well, a lot's happening in Include these days. I think Include, as you know, is a fintech fund focused on Egypt.
Tell me about the name.
The name Include,
Yes.
yeah, it comes from financial inclusion.
Mm-hmm.
So the idea was, how to be inclusive and how to bring more people into the banking system and
Okay.
more businesses into the banking system. Egypt still has very low penetration of banking to individuals. So there's like less than 60% of people have have debit cards. Less than 80% of people have credit cards. There's more than 1 million businesses that don't have bank accounts. So
Okay.
it's quite a challenge. And by bringing them into the banking system, obviously they get to access credit, they get to get more services, lower their cost of operations, and things like that.
Okay.
Yeah.
Okay, so that's Include. So
Then
you want to be more inclusive.
we want to be more inclusive, right?
Yeah.
On the financial side, that's the focus. But obviously, the word include is a play on, getting how do you bring everybody into the system,
Okay.
partner with the banks and partner with the startups. We also have a program called Include Her, which is about, mentoring and working with female entrepreneurs.
Okay.
Egypt is pretty low on the scale of female entrepreneurship. So the idea is to see if we can find some early stage entrepreneurs and support them.
What is it mostly cultural in Egypt, or like why do you think there aren't a lot of women in the
Well, entrepreneurship is new in
Okay.
Egypt, I would say. I mean, there on the one side, there's a lot of small businesses, so you could say Egyptians are by definition entrepreneurial. But tech entrepreneurship, the idea of starting a business online and all of that, is relatively new.
Okay.
And so it hasn't attracted as a wide a spectrum of people as you would expect. It's not just a gender thing. I mean, it's pretty narrow focus, usually people who've lived abroad or studied abroad who come back and start an online business. I think with some of the programs that the government and some of the accelerators, 500, Global 500, and so
Mm.
on, are doing, we're starting to see a wider base of people entering the kind of tech entrepreneurship. So yeah, I think on women in particular, we're seeing a pickup. Don't get me wrong, and
Okay.
there's a few very, very, very strong entrepreneurs. Hiba Gabali, Ifrishli. There's Yasmin, who has a logistics startup, and there's really some great entrepreneurs. So I'm a fan of what's happening,
Okay.
but the numbers still, have a ways to go.
Well, Egypt's doing very well in terms of the venture capital funding, right? It was the receiver of third of the funds of VC funds last year in the MENA region after the UAE and Saudi Arabia. So there is money starting to pour into the ecosystem. But there's also a lot of trouble, right, in Egypt. So I read yesterday that there was a report that says that the World Bank said that food inflation is at 62%. Inflation in general, I think, is at 26%. The pound is being, devalued. So what's happening?
So I would say right now Egypt's in trouble, definitely economically. I think it's a confluence of events, some of it really out of control from or out of the government's control. The war in Ukraine is being blamed for quite a bit of it.
Okay.
Egypt
How
used
so? And the
because
food?
Egypt used to receive about 60% of its tourists from Eastern Europe.
Oh,
And
interesting.
so the
Okay.
fact is that, and that was a very important source of dollar income for the country. So there's been a huge drop. But also at the same time, Egypt imports a lot of food, wheat and other things. And a lot of it also came from Eastern Europe. So unfortunately, the two events together have really put Egypt under some economic pressure.
Okay.
There's also an argument that there's been a lot of government spending that has happened
On
on
infrastructure?
infrastructure, very much needed. But the question is, how much can you do at one time, and how big are how big are these projects, and how important are they to the economy? Some of them, like the new administrative capital and so on, are long-term projects. You're not going to see a return on those for a very long time, and so in the short term, it's putting again stress on the system. So I think people are coping, but yes, the currency has devalued by about 50% over the last year, literally a year now, since last April. And as you can imagine, the consequences, inflation, the value of companies is being halved. So even if you're growing as a startup rapidly, you're from an Egyptian pound perspective, from a dollar perspective, you're losing half of it in the last year, which is very frustrating if you're an entrepreneur. So I know a lot of startups that have did 3 or 4 times growth of their business in the last year.
But in US
But
dollar.
in US dollars, it's like 1 time, 1.5 times, 2 times. And unfortunately, that has its consequences.
So what do you do then? I mean, you are a VC based in Egypt. You raised money from Egyptian banks,
Yeah.
right? And what happens then?
There's a couple of things to consider. First of all, Egypt still remains long term a very important market. 105 million people, growing, very young population. People are still getting online. So the opportunity remains there. The question is, how do you navigate the troubled waters and in the short term? Some of it has to do with some very basic things like managing the costs, managing your runway. If you're a startup, how much money are you spending? So you have to be careful because fundraising is becoming difficult. I mean, it's becoming difficult globally, you know
It's
that already.
yes.
And it's just becoming even more difficult for Egyptians. But I'll also say Egypt's been there many times before, right? It's not the first time that Egypt goes through the stress, and entrepreneurs are pretty resilient folks, so they've navigated this. But a lot of startups are also looking for expansion. So they're looking at how do I go to other countries where I could have a diversified revenue stream in a different currency. Saudi Arabia is obviously on top of mind for many of them, for the obvious reasons that I'm sure you know already, that the ecosystem there is booming, the economy is booming. So they see it as an opportunity, I guess. But also UAE is another market that they're looking at. Some startups are looking at Africa, so looking at Kenya, looking at Nigeria. So it depends on the business, right? If you're in logistics, I think Africa makes more sense. If you're in fintech, then probably Saudi Arabia, UAE makes more sense.
Isn't the UAE and Saudi already saturated when it comes to startups and fintech, for example? I mean, there are so many, and I feel that everybody wants to be here. So wouldn't kind of like the natural expansion for Egyptian startups be in Africa, even if they're not in logistics?
Yeah, no, I agree with you that ultimately there's a lot of competition
Yeah.
everywhere, actually. Even in Africa, there's a lot of
Okay.
fintechs as well, not just in Saudi. But I guess the idea that Egyptian startups have a lower cost of operation, they always say put the kitchen in Egypt.
Yes.
Yeah, and the idea being that you can hire a good sized team for a much lower cost than you can elsewhere. And so that could be one of the advantages of being able to compete. But I agree with you. Fintech has grown tremendously in the region over the last few years.
And you have challenges, right? When it comes to scaling fintechs, you have different regulations, different markets have different requirements. It's not that simple, right?
Yeah, but I think it's also at this. Of course, nothing is simple, right? And with competition, comes comes a lot more execution risk, if you like, right? And being able to find your product market fit and being able to find the right solution. But to be very honest, Lulu, I think the other thing you will see is that the market opportunity for fintech is still very, very large. I mean, as I mentioned, Egypt is underbanked tremendously, but even Saudi Arabia and UAE is underbanked. So in the SME space, for example, there's probably 250,000 SMEs in the UAE that don't have a bank account, right?
Okay.
So, you think of this as a very modern country, and it is on many different levels, but it still has its own challenges. Small businesses don't have access
They
to.
don't have a corporate account, basically.
They don't have a corporate account, and they definitely don't have access to credit, right? So even if they have an account, many times banks here are very reluctant to lend small businesses because it's a lot of headache, right? That small businesses are small tickets, and collections is always a challenge and things like that. So they prefer not to. They prefer to lend to the big businesses. It's just easier for them.
Okay.
And they don't have the same expertise like fintechs do with collecting data and analyzing it and building models for risk and management that fintechs can do. So the opportunity exists everywhere still. And I think, you always say, is fintech saturated? Yes, maybe. But at the same time, it's also the largest opportunity in the market at the same, that I think all investors see.
Well, you clearly see that your fund focuses on fintech.
Absolutely.
So basically, going back to Egypt, then entrepreneurs are trying to deal with what's happening by trying to expand potentially to other markets, adjacent markets. Is that what's happening?
I think that seems to be the go-to strategy for many of them, right?
Okay.
Now, whether that's right or wrong, that we can debate, and each company is unique and each situation is unique. So I'm not sure it's the right answer for everybody.
Okay.
But a lot of them are thinking about Saudi, UAE, and maybe other GCC markets. Some are thinking about Africa. That is the go-to strategy.
Do you think it's the right strategy?
Not for all businesses. I think some businesses are good to come to these markets because there is an advantage to playing with cost, like I said, and so on. But I actually think some of them just need to double down on their own businesses in Egypt. Right?
I would think so also, right? Because I mean, if you've raised some capital to launch a business in Egypt, and all of a sudden you're trying to pivot into Saudi, first of all, the economics are completely different.
Yeah.
The time that you're gonna spend, you need whatever 18 months maybe to get a license in Saudi as a fintech, for example. Same thing here. So this is all time and money, basically, that should have been going to Egypt that are going somewhere else, and it doesn't make sense.
Listen, like I said, it's unique to every company.
Okay.
So there's probably cases where what you're saying is absolutely true, and I think there are some cases where it does make sense to expand. So PayMob is one of our companies in the portfolio, doing really well in Egypt, already built a very large business.
But PayMob is not a new company.
It's not a new company. So for them, expanding was always in the plan. All we're doing is accelerating it, if you like, moving a little bit faster.
Yeah.
But if you look at companies that are maybe just starting out, companies like Simple, for example, or doing BNPL, they probably need to focus on their Egyptian market. First of all, there's a lot of competition already in Saudi and UAE. So for them to come in when they're still small is probably meaningless a little bit. And that's what they're doing. They're focusing on their own core markets.
Interesting. You mentioned BNPL because, Tabi pulled out of Egypt, at least they said temporarily.
Yeah.
So that was interesting.
Yeah. The cost of capital is very expensive right now in Egypt. So you have to remember that the bank interest rate has been raised significantly. It's at around 19%. That's the interbank rate.
Wow.
So when you borrow on top of that, you probably have to pay another 4, 5, 6%. So you're talking about 24, 25% interest rates. That's a very high rate of borrowing, right? So
is Egypt in a recession?
No, it's in an economic turmoil situation.
Okay.
So the interest rates are reflective of, investors' worries, let's say. But it means that if you're running a BNPL, then you can't make enough money to cover your cost of capital. So you have to be very careful with it. Now, if you're borrowing in Egyptian pounds, it's a little bit easier. If you're borrowing in dollars, it's a lot more expensive.
Can you borrow in dollars?
You can, but then you're taking on currency risk, right?
Okay.
And that's not necessarily a thing you want to be doing right now, especially with the strength of the dollar and the weakness in the Egyptian pound. And so
okay.
on. Yeah.
So what are you doing as a VC then? So the startups are trying to expand.
So the strategy for this year has really shifted from last year. So last year we were still in a bullish mode, even though the world was starting to, falter a little bit. There was still a thought that VC is long term and you have to kind of see through the ups and downs and keep investing. So we did 8 transactions last year. We invested in 8 startups, which was great.
Is that what you typically want to invest in, more or less, or?
Yeah, I think 6 to 8 a year is kind of a good pace, right?
Okay.
Especially with a new fund where you're still building out your, team and resources and capabilities and so on.
Okay.
So we were super excited and kind of bullish. By the end of the year, we started to take a step back, right? Especially when the currency devaluation happened. I think the focus this year is more to support our existing portfolio with follow-on investments and supporting them to make sure that they're well capitalized to get through this, next year or two, depending on how long this kind of crisis goes on. And I think we'll continue to look at very early stage seed investments and pre-seed, maybe pre-series A. The idea being that when you're investing early stage, you're really betting on a team and you're really betting on an idea. It's not really trying to put a valuation on the business model yet, if that makes sense, right? Because they're still developing a product, they're still developing a solution. And if it's going to take a few years for this crisis to be over, that may be a good time for those companies to build some really interesting products.
Would it be, though, a risk in terms of their ability to raise follow-on funding? So if this crisis continues another 18, 24 months, I mean, depending on who you're listening to, this is what I'm hearing. Then, would they be able, you think, to raise these additional funding? Is that like an extra risk now when you're investing in pre-seed or very early stage companies?
I don't think it's an extra risk. I think it's a risk that's always been there, right? When seed companies are raising money, there always is a worry about how you're going to raise the next round and what do you need to achieve and to show.
There's that chasm for sure between
Yes,
like between
sure.
the seed and the A, but
yeah,
it's even more challenging now.
You have to take into consideration something we call capital efficiency. So we always think a lot about how efficient is this business with the capital that it's using. Long gone are the days where you can just burn a lot of money to capture customers that are unprofitable in the hopes of getting to a certain size where, hopefully, profitability will somehow kick in. You're looking now for businesses that can be profitable from pretty much day one. So from the first sale they make, they need to be making a margin. And then you need to believe that the margin is big enough that it won't require a huge organization to sustain the business. So one of the investments we did last year is a company called One Order. It's B2B supply chain for HoReCa industry, so hospitality, restaurants, and so on. Think of it like Mexab but for hotels and restaurants. And One Order within 9 months became profitable down to the net income line. So not only are they
within 1 month,
within 9 months.
9 months, sorry.
Yeah.
Okay.
So they grew their business. They're doing over $1 million of revenue a month, and they're generating a net income of 3%. So they're actually profitable business. And so that opens up all sorts of things for them. Now, equity investors are chasing them. The people want to invest in that business. And obviously the company doesn't need to raise funds. Now we have access to debt. So banks are willing to lend because there is a profitability line.
Okay.
So I guess my answer to you is it can be done. It's not every business, and it's a pretty unique one. The entrepreneur and the team there is really strong. But to build $1 million a month revenue business with only 30 people working in the company is pretty impressive.
Okay. So you don't see the risk of investing early?
There's always risk, right? So I start in a place as a VC where I'm comfortable with risk, right? If you're not comfortable with risk, don't be a venture capitalist. The question is, how do you assess the risk? How big is that risk? And what are you doing as a VC to mitigate that risk? Nclude does a lot of things to reach out to international investors. So we host events pretty much every month with global VCs from London, from the US, from here in the Middle East. And we bring them to introduce them to startups in Egypt and to show them what the opportunity is. And we've been very fortunate. So QED, one of the largest fintech investors, invested alongside us in one of the companies in Egypt. We've had Delivery Hero Ventures invest with us in one order, the one I was just talking about, and so on. So the bottom line is we're trying to mitigate the risk that you're referring to by bringing not just capital from within Egypt, but also outside of Egypt, so that the companies have, sources of funding that can sustain them. But risk is the name of the game. I mean, that's what VC is. So
that's true.
More risk, less risk, I guess. Yes, I agree. There's more risk, but I would also say to you, this is the game. That's part of what we do.
What else do you do to mitigate the risk? Interesting, because you're looking at often like really early stage companies, pre-seed companies. So other than now, for example, in the situation that you described where you're bringing in external capital as well, capital from other countries, what else do you look at that is maybe different than what you did before, or is it still the same?
I think, well, hey, there's so much learning from the last few years that definitely there's a lot of new things that we're trying to do. One of the things that's definitely top of mind is governance. Having a good board, having an excellent set of financial reporting, a good CFO, even if the company is very young, has become more important than ever before. I think during the kind of time when VC was just booming and money was being thrown around a lot at startups, I think this went a little bit overlooked, if you like, and it's led to some issues, obviously. So at this point, we're very focused not just on helping companies raise money, but also the way they manage their money, right? And being involved a little bit more than in the past with their reporting, with their spending, and giving advice, looking for opportunities to save money. A lot of more transparency in the financial reporting, so we know what's really going on.
Yeah, you had a very interesting story last year in Egypt with a very well-funded startup, Catheter, which is a B2B e-commerce company that raised $33 million and collapsed end of last year. Reasons attributed to mismanagement, right? Lack of governance. Is that correct? Or is it more the economy kind of situation?
Catheter is definitely an unfortunate story from last year. One of the ones that was quite public and quite highlighted in the news. I don't think it's all finished yet. I think the company is being wound down still. So I'm not sure we know the full story just yet. But definitely there was a discussion around, is it mismanagement? Is it the board governance? And probably the answer is it's everything, right? It's going to be a little bit of everything that caused the problems that it got itself into. But effectively, they were running a very low margin business. Some people say it was even a negative margin business in terms of gross margins, because they were giving so many incentives to their customers. And they needed a lot of capital to sustain that business. And they were raising that capital. And then all of a sudden, that capital dried up very quickly. And they find themselves in a lot of trouble. Now, is that an issue of management, board, the investors? I guess everybody should take responsibility for it. That's for sure.
Or the economic conditions, maybe that kind of...
There's no doubt the economic conditions played part of it. But that part was, I would also say foreseeable, right? It's not like we all didn't know beginning of last year or even the year before that at some point this boom cycle is going to end. And I think there were many good entrepreneurs who took actions early to manage that, right? Some earlier than others, and some waited too long. I guess Catheter is just an example of waiting, way too long so that you run out of funds effectively.
Have you been in a situation personally where you had to choose, for example, in between two portfolio companies, who to support financially and like who to cut off? Have you been in this situation personally?
Yeah, I think of every investment, whether it's a new investment in a new company or a follow-on investment, as a new deployment of capital. So you assess it on the merits of what it is at the time, right? So follow-on is not a given. I think many entrepreneurs sometimes wrongly believe because you've already invested in them that you need to continue to support them. And I don't think that's true. I think they have to show and prove that they are worthy of more capital And as always, it's competitive. So yes, of course, I've been in a situation several times where you're looking at portfolio companies and you're going, I can't afford to back all of them. I can only back a few. Which ones do I want to continue to back? But you start from fundamentals, which, given what you know today about the market, about their business, about their performance,
Yeah.
where would you rather put the next dollar of investment? And sometimes that answer is not even any of the portfolio companies. Sometimes it's even a new investment.
And how does that conversation typically happen with the founder? Because that's a very sensitive conversation that can have ramifications, because it also sends a signal, right, to other investors that their existing institutional investors are not reinvesting.
It's one of the toughest
I'm
conversations to
sure.
have, right? And comes with a lot of negativity, I guess, especially if you're saying turning them down or saying no. And to the point that you said, it sends signals to other investors, and signaling and FOMO and all of those things are very important part of VC investing. So when people see others investing, they want to get in, and you know how it is.
Yeah.
So it's difficult. Now, a lot of it depends on the maturity of entrepreneurs. So we're lucky at Nclude that 6 out of our 8 entrepreneurs are endeavor entrepreneurs. Many of them are second-time entrepreneurs. They've been through, a business cycle. I think half of them are on their second startup and so on, which is really interesting to see how the ecosystem is maturing. I think with those founders, you find the conversation a bit easier because they've been through it before. They understand. They usually want to know early if you're going to follow them or not, and they manage the conversation. They control the message in the market. I think for some of the younger, let's say, younger is not the right word because you can have older but new, but nonetheless, some of the newer entrepreneurs who don't anticipate this because they haven't been through it before, yeah, we've had some difficult conversations, and sometimes it gets a bit personal. I have to say, people take it personally. It's like it's their baby, and they don't understand that from a VC side, it's a fiduciary duty in terms of investing and doing what's best for your LPs, if you like.
I think that's one of the hardest conversations, by the way, in terms of, obviously, not following on for a portfolio company is probably even harder than saying no to somebody, like to a new investment, because there's no relationship, right, between you, and maybe
Correct.
it's just easier to say no. But it's still so hard because there are so many great people out there building some amazing companies, and then sometimes you have limitations, maybe nothing to do with them. Maybe you're just not deploying,
you don't have enough
or
money.
or maybe you're not investing in this particular sector, or so on. And then it's a very hard conversation. I'm starting to experience that myself. With the syndicate, it's like we can invest in 5 deals or 6 deals per year. That's the bandwidth today, right? So unfortunately, you meet so many people, and you have to have these conversations.
I will say it's the toughest part, right? And I think a lot of times your intention when you're starting a conversation with an entrepreneur or even a follow-on is that you want to do this deal, you're excited about it.
Yeah.
But circumstances, as you said, whether it's availability of capital, whether it's sector focus and where your interests lie,
Or something comes up in
or something
the
comes
due diligence that you
exactly.
don't like, or
And that's the hardest one, the
Yeah.
due diligence one. I mean, I've had a few entrepreneurs get pretty upset with me about, saying no to them and being very vocal and public about it. And as a VC, you can't share publicly why you passed, right? Because if it's something in due diligence, it's something you discovered and you don't want to say it out loud.
Okay.
So, yeah. So you kind of keep it to yourself and then just take the beating.
Take the beating.
And move on.
The public beating.
Take the public beating. Oh, this guy always changes his mind. He doesn't follow. And you're like,
Yeah.
well, you failed tech due diligence, but we didn't want to really talk about this. And I guess my point to you is, maybe other investors will see something different, right?
Yeah.
And so you don't want to publicly say your opinion because it's not fair either, right? To say that it would be detrimental. You'll be causing more damage. And maybe another investor sees something else and wants to back it. But I'm with you. This is the toughest part of VC, saying no. I mean, if there was anything, I'd want to say yes to everybody, but it's not even possible to do that. There's not enough capital. I think the good entrepreneurs know how to ask those questions early on and make sure they don't spend time with the wrong VCs. if that
And
makes sense.
that's crucial, by the way.
That's crucial. And by the way, there's nothing wrong with asking those questions. I'm more than happy to tell an entrepreneur, listen, I'm looking at 3 other deals right now.
Yeah.
You're not my priority. I like what you're doing, but I have other things that are taking up my time.
Yeah, yeah.
And it's very easy for an entrepreneur to say, good, when you're ready to talk with me and have time, let me know.
Yeah.
Do you see what I mean? That's a fair conversation.
Yes.
Nothing that should upset anyone. The worst thing you want to do is be spending time with me and not realizing that this isn't a priority for me, right? And vice versa. I need to be disclosing that and being able to talk about it.
Yeah, I think VCs would maybe always take up meetings because it's part of what they do, right? It's, I mean, part of the job of a VC is to have information and have a bigger, kind of wider view of the market and what's happening and what are the startups and what are the
I
new
always say
business
VC is a
models.
lifestyle, right? So we live our jobs. You know this with Spade Ventures, which I'm sure you're meeting lots of entrepreneurs all the
Yes.
time. It's a lifestyle. You meet people because you want to get to know them. You're curious about their ideas, their thoughts. You want to help. Sometimes helping them is making introductions to other VCs or making introductions to other people or so on. So the intention always going into a meeting is great. But if you don't get clear alignment right at the beginning about, what you want and what's the timeline, then I think that's when expectations start to be a problem.
Yeah.
But yeah, VCs take meetings all the time. I mean, my family hates me because I'm, taking meetings in the evening and on the weekend and early in the morning. You know what it is. You know what it's like, right?
Yeah.
It's a busy lifestyle. That's it.
I think that the message that I learned is that it's not personal. When I was an entrepreneur and when I was fundraising myself, when you obviously believe your idea is the best in the world and you're fantastic and you might be, but again, it might not be for everyone.
Yeah.
And some people might see different things. And I think this is something that maybe more experienced entrepreneurs, as you said, would know how to deal with versus new entrepreneurs or less experienced entrepreneurs. And it's just really not personal.
I believe it's not personal, but I can understand why it can get personal.
Yeah.
Right? Because it is at the end of the day your idea, your life, you're dedicating, you're doing a lot of sacrifices as an entrepreneur to build this business. And so when you get rejected or said no, or you're chasing VCs, it can feel personal for sure. But it's not, right? No one takes it as personal. I think the journey is as equally important as the destination. So yes, companies need to raise money, but part of it is also building relationships along the way.
Yeah.
And what I found, some of the best companies you've invested in are not ones that I met yesterday or just recently. They're entrepreneurs I met once and twice along the journey. And at the time I wasn't interested, or it didn't make sense to me, or it was too early, or it just something wasn't right. But that entrepreneur made it a point to stay in touch, send regular updates, maintain a positive outlook on the relationship. And then you find over time, you know what, that entrepreneur is right.
Yes.
I think idea is actually a good idea. And you're like now scrambling to get into the deal and to make the investment. VCs are, we're definitely, what's the right word? We think about the long term, but when we're working on transactions, your time is very intense, right? Because you're investing in a particular deal, and that's taking up all your time. So even if you're meeting new entrepreneurs, you just can't focus as much on it.
Absolutely. I think there's a lot of momentum building as well. I mean, there's you might probably know a guy called Chamath Palihapitiya. He has
of course.
a very famous podcast called The All In Pod. And he said that part of the problem of what's happening today is that there's a lot of correlation between like portfolio companies among the top VCs. So he said that there's a lot of VCs pretty much investing in the same deals. And this is a problem today because, with the correction that's happening, you're going to see a lot of value being basically wiped out. Actually, he's saying there could be up to $1 trillion in value that could be wiped out with what's happening. So how much do you see that behavior here in terms of like the kind of that, I mean, I'm going to call it herd mentality, but not in a negative way, but because, I mean, it is what it is, right? Sometimes you see other experienced VCs excited about something and you think, okay, there must be something there. So how much of that is here, basically?
There's quite a bit of herd mentality in the region, no doubt, right? But I don't like to think of it as herd, right? I think of it as companies are raising some substantial capital,
Yeah.
and rightly so. Some of those businesses require you to raise 10, 15, 20 million dollars, 30 million dollars, and there aren't many VCs who can write checks that big.
Yeah.
So the bottom line is entrepreneurs and startups have to raise money from multiple VCs, and they have to convince multiple VCs to come on board. And in some ways, that's a good thing, right? Because if 2 or 3 VCs are backing a startup, then it's diversifying their capital base. Maybe one VC can continue, another one can't continue for the reasons we mentioned earlier. And so the bottom line is it's a good thing to have multiple VCs on your cap table for the long-term viability of your business. But the real issue is that we don't have growth funds in the region, right? That's the so on. So you're getting to the stage when people have to raise 20, 30, 40 million dollars. They have to unfortunately club it from several, VCs. Now, on the flip side, is there a bit of a herd mentality? Sure. There is like we said, there's signaling. If one investor is investing, you're kind of going, what do they know? And,
Yeah.
and I want to be in on that deal as well. But we've now seen, enough startups and enough VCs that usually in any one sector or any one subsector, there's 3, 4, 5 companies that are getting funded by different VCs, right? So if you look at logistics, there's several players funded. If you look at B2B supply chains, there's several players being, funded by different VCs. So yes, I guess the answer to your question is yes, it's true to some degree, but I think increasingly as the market matures, it's becoming more competitive.
And do you see what are you seeing now in terms of the valuations? Are there a lot of, have you seen down rounds already, or are people trying to work their way around them by raising a bridge or some kind of note or something, or have we started that here?
So I think on average, I'm starting to see valuations coming down from peak about 30, 40% at this point.
Peak being last year?
Yes,
Or yeah.
peak being beginning of last year, let's
Okay.
say. So we're already starting to see down rounds. Of course, there's a lot of creativity being applied, whether it's bridge rounds or uncapped safe notes with discounts, or people trying to find clever ways, to come up with a different number. But the reality is, if you look through it, the transactions are at a lower valuation than they were. Egypt, especially, is seeing a significant number of down rounds as we speak. I think that's healthy, in my opinion. I think it's good.
Okay.
We had peaked, and we need to correct for that peak, and capital needs to be more efficient, if you like, in the way that it deploys into startups. So that means an impact on valuations. I think the hard part is to figure out the incentive and motivation for the management team, right? So if you're doing a down round,
they're gonna be wiped out the most.
Yeah, they're gonna be definitely losing a lot of equity rapidly. Now, you could argue that they shouldn't have had that in the first place because the valuation was too high on the last round. So that's one argument, but it doesn't matter. The reality is, the entrepreneurial model or the VC model only works when entrepreneurs own a meaningful stake of their businesses, so that they're motivated to build. So we've had to also do some ESOP,
Employee stock option pools.
Yeah, exactly. Employee stock option pools, and some ways to get the founders or the management team, motivated again by giving them back some shares, etc. And I think that's a fair deal, if you know what I mean, right? I want more equity, but I'll also make sure that you can continue to have a big stake. I think it's the other investors who, get squeezed into this.
The angel investors, the common investors, right?
Maybe the angel, definitely the Series A's are getting squeezed lately by new investors coming in and kind of squeezing down the rounds that they did. So it can be a combination of the two.
Is it a good thing as a VC to come in to lead basically a down round? I'm just thinking about the existing dynamics already in the company and the baggage that it comes with and all of that.
Like many things in the ecosystem here in the region, it's new to people. Let's put it that way.
Yeah.
So we have to remember, we want to talk about VC in the region as though it's been going on for a very long time, but the reality is it hasn't.
10,
right?
15 years maximum.
Maximum. And especially for for a lot of companies, they've only been around for a handful of years, right? So the companies that have been around 10 years are heroes in my mind, because they survived some of the
Or zombies.
they survived some of the toughest situations when there was no capital at all.
Yeah.
But for a lot of companies that only started 3, 4, 5 years ago, this is the first down cycle that they see.
Yeah.
So for investors, for the entrepreneurs, it's a learning curve. Is it good to have down rounds? Of course not. But you have to ask yourself a question: is the down round happening because the company's not performing, or is the down round happening because the valuation of that sector has changed? Right? Those are two very different discussions and very different ways to look at it. If it's happening because the sector valuations are down, then this is just the way the world is looking at valuations, right?
So the multiples. So
the
basically
multiples,
it used
exactly.
to be a multiple of 10.
And now it's 6.
And now it's 6.
Yeah.
Yeah.
So this is not on the entrepreneur. It doesn't say anything about the entrepreneur being good or bad, or the business being good or bad. The world is what it is. I mean, real estate prices in the UAE, they go up, they go down, they go up, they go down.
Yeah.
And you have to try to buy when it's down and sell when it's up. And that's the way the world is, right?
Yeah.
Unfortunately, most people buy when it's up and then sell when it's down, and then they complain. But the bottom line is, it doesn't say anything bad about the entrepreneur. It just says something that the market has changed.
Yeah.
I think if the valuation is being brought down because the business hasn't performed to expectations, then I think there's a lot more questions to think about, right? Is it the right management team? Is it the right product market fit? Is it the right pricing? Is something, is competition too intense in that space that you didn't really evaluate it properly during investment? And that makes it a lot more tricky, if you want, as a down round. So I've seen companies, and I can think of a couple that are doing down rounds right now. I'm not going to mention their name because they probably don't want it out in the market. But I know a couple of entrepreneurs are doing down rounds, and they're happy to do the down rounds, right? They're very positive about it.
Well, at least they get to continue building the company.
Yeah, and more importantly, this business I'm thinking about particularly, has tripled its gross margin in the last year.
Okay.
Right? They've had such cost improvements, such improvements in collections, and all of the, money, collecting their money from the clients, all of that stuff, that they've actually improved their margins tremendously. The down round is simply because the sector is down, right? Okay. This is it. But they're raising more money. They've agreed with the investors on an ESOP plan, and they're going to be perfectly fine.
So they'll ride the storm, basically.
They'll ride the storm. They'll be fine, and at the end of it, they'll make, I think, just as much money as they would have done if it had just continued on the upside.
Okay, but do you think, you said earlier that valuations had peaked here, but there was always this thing that companies, startups in this part of the world are always at a massive discount, for example, from a similar startup in a bigger market in the US and so on. So there was always this complaint by entrepreneurs that the valuations weren't high enough. So do you think between 2020 and 2022 that changed dramatically?
I think definitely during COVID 2020, 2022, when everybody got super excited about tech and investments, that gap had really become a lot smaller. So I agree with you. A few years ago, that was true. I don't think during that period that gap was as big as and I didn't hear that complaint, I guess, as much during that period.
Yeah.
But that being said, there's a reason why there is a discount, right? In the Middle East versus other markets. First of all, it's a discount related to the size of the economies, right? And the market size. And we're not talking about economies with petrodollars, right? We're talking about just the real economy minus the oil side. So how big is the consumer base? How many people can you sell to? How much can they, afford to buy of your product, etc. And the Middle East,
fragmentation.
Yeah, and in the Middle East is a relatively small market, no matter which way you cut it, right? Yeah. The fragmentation, which means, like you said, every market is different. We're not even like Europe. Though Europe is fragmented, but at least it's one market, right? Where you can get a license in Germany and sell in other markets. Yes, language is an issue, but at least it's one market. Yeah. Here, it's not one market, right? To go from, especially for fintechs, to go from UAE to Saudi is a massive challenge.
Go from Dubai to Abu Dhabi.
From Dubai to Abu Dhabi, you're right. And then, the market difference is Egypt's a huge market, but the value transaction is much, much lower, right? So, the economy on a per capita basis is a lot lower. Saudi, maybe they have a big spending, but there's a lot of competition and there's other anomalies around family-owned businesses and their ownership of the market and some of those idiosyncrasies, if you like. And you come to the UAE, which is always my favorite market because it's really open market on money levels, but at the same time, it's not a sizable market. It's 10 million population, with a big portion of it being blue collar workers. And so it's, again, it's still a limited size, right?
Yeah.
How much can you do? And again, what I'm saying is very general. Every business is unique. Some businesses will work better here. Some businesses will work better there.
Yeah.
But the bottom line is there's a discount for that. And then the last discount that everybody forgets is something called the liquidity discount, right? So if I'm going to sell my shares, if I'm going to buy shares from you, and I'm going to hold them for 5 years, and I'm going to sell them, or I'm going to IPO, or I'm going, whatever it is that's going to happen. And IPO is very rare. So let's take the sell example. Then how many people are going to be willing to buy my shares, right? And M&A has been very, very thin in this part of the world on tech companies. It's improving, and I think Magnet and others have been putting out statistics about how it's doubling each year, but doubling from 6 transactions to like 12 transactions. It's nothing, right? You're talking about, there's probably 12 M&As in the US per, I don't know, half a day or something, right? There's like 20, 30 M&As a day, literally, in tech. And over here, we're doing 12 a year, right? If we're lucky.
I think it's a bit higher than that.
Yeah?
If you go back to Magnet, I think it's
40, I think was the number they threw.
It's not very high, but I think it's,
My point being is we're starting.
It's not a lot.
It's not a lot. So the discount of liquidity has to do with my ability to exit, if that makes sense, right? So you're really trying to say, I need a discount so that by the time you grow the company and I look to sell, the company, you look to sell the company, or I look to sell my shares, or whatever, whatever the case might be, I need some discount that compensates me for the risk of not being able to do that, right? Or how long it's going to take to do that. I know M&As here that have taken more than 2 years to complete because there's just so little, tension in the market, and the buyers taking their time, and the seller is a little bit reluctant because the price isn't the right price, and so on and so on.
Interesting. Very interesting point, actually. So how do you account for that as a VC? Are you able, do you have to wait it out until there's some kind of acquisition from a global player, or, an M&A here, which is not so likely or might take a lot of time? How do you mitigate for that risk?
I think there's first and foremost, I'd say all of us in VC are taking a bit of a leap of faith right now, right? Because if we went purely with the statistics and the numbers, you probably wouldn't make any investments. You'd probably just say, I'm never going to be able to exit my position. So we're taking a leap of faith that we are we're growing the market, right? We're building a new industry, and that M&A will get better, and it will get stronger, and it will become an important part of exiting. So that's what I would start off by saying. That leap of faith is really important, because if you went with pure finance fundamentals, this wouldn't be the most attractive place to invest from an exit point of view. But once you get over that leap of faith, I think the way you look at it is to say it's easier to invest early, because you can see your money, and if you're investing in a company at, let's say, $5, $6, $10 million valuation, you can see companies growing to 20, 30, 40, 50, 100, or whatever the case might be. It's more challenging for later stage investors to invest at, let's say, a $500 million valuation and believe that they're going to still see a company grow to $3, $4 billion, right? Because how many people can afford to buy a $3, $4 billion company in the region? I know we think of the region as wealthy, but the reality is that's in a very particular sector, right? In oil, gas and oil, and so on.
And real estate.
And real estate. But everywhere else, it's not the same, right? So that's one thing that a lot of investors consider, is what stage to come in at, okay? That being said, I think the bottom line is the market is, or I should say, put it this way, the economies are starting to understand that here technology is here to stay. Technology is a fundamental part of the diversification of the countries, and that these industries can be meaningfully important. And so my positivity, if you like, comes from that. I think that leap of faith I mentioned is starting to happen in a big way. And the M&A market has actually picked up quite a bit. Now, it takes time for these transactions to happen. Sometimes they're not announced even because it's private deals. And so we'll never know fully everything that's going on. But I can see conversations have picked up tremendously over the last 6-9 months.
I think there's an interesting thing that you said about investors taking in a leap of faith. I think it's quite entrepreneurial, actually, because entrepreneurs also end up taking a leap of faith when they leave their jobs and whatever they're doing to start a new business. And I think the other point when you said the word leap is that there's always the notion of the region here leapfrogging when it comes to technology, right? It's so kind of antiquated, and there's the opportunity to kind of like skip through a lot and adopt these kind of new technologies. So there is an opportunity there. Speaking of M&A, obviously the biggest announcement of the week was E&, which is formerly Etisalat, investing $400 million in a newly formed company, a team called Careem Technologies, which is separate from the main ride-hailing business, which remains owned by Uber, as I understand fully. And that new company is owned by Uber, the co-founders, and E&. Nobody knows what the cap table's like, but I think E&. has a majority stake now. So what are your thoughts on this? I mean, that's a big M&A. Well, I mean, that's not really a full acquisition, but it's a big transaction, right?
Yeah, it is definitely a big transaction. I think we're all trying to learn exactly the details of the transaction and how it all came about. But it says a lot about the maturity of what's happening in the region. I see it as a formidable move by E&, in terms of moving towards their vision of being a technology platform and not just a telecommunications company. And I think it's putting their money where their mouth is, if you like, and making it happen. They've been talking about it for the last year with their new branding and all of that. I think it's a representation of what I would say wave 3 of the market. So wave 1 was startups coming about. Wave 2 was starting to see some companies raising large tickets, 100 million, 200 million, a couple of IPOs here and there, and a couple of M&As here and there. This is really about the start of what I would call a platform business.
Okay.
So my understanding of Careem Technologies is that you're taking all of the assets that are related to non-ride hailing. So things like food delivery, things like financial wallet, pretty much a super app mentality, and building that as a platform that can plug and play a lot of other technologies onto it.
Yes.
Think of it as our first, I don't want to say Meta or Facebook, or think of it as our first Google or something like that. But I think it's the start of a journey that has such huge potential for entrepreneurs who are super experienced with a backer that is financially very strong, and a connection to a global player like Uber. Putting all of that together can really be the start of something new in the region. So I'm hoping that that's part of what's going to start more M&As, because I suspect that, Careem Technologies, Mudassir and gang are not going to just want to build, but also buy companies. I think it's the start of us having our own regional champion at that scale. And I think that creates some very interesting opportunities for sure.
Do you think it has to do with, the CEO, obviously, of E&, who was an angel investor himself, who kind of was in this startup ecosystem, believed in it, that he saw merit in this transaction, or do you think it has to do with that kind of culture?
Yeah, listen, the team at E&, is quite a formidable team. Hatem, the current group CEO, has been a well-known person in the technology scene. I think he at least used to, I'm not sure he does now, but personally invest in startups, Dubai angel investors. He was a member of, that's how I know him. And I know that he would give a lot of his time outside of his very busy job with startups, with founders. So just like you and I do, he's also addicted to the notion of entrepreneurship. And that knowledge gives him an advantage as a CEO of a large company, that he knows what's happening in the startup world and understands the risk and understands the opportunity. But I love the way he's approached it, right? And the way he's approached it is to look at what is the biggest opportunity, for consumers in the region. And Super App is been talked about for several years. And I think we've seen Grab in Southeast Asia and we've seen others around the world be very successful, but we haven't seen that happen here in the region yet. And he's partnered with, three of the best entrepreneurs that are in the region, right?
Yes.
I mean, the Kareem story is well known. It's no need to repeat it, but it's not like these three entrepreneurs are new to the scene. They are some of the more legendary entrepreneurs having built and sold Kareem. And I think they've partnered to embark on a new journey. And I'm super excited about it.
Yeah.
Don't get me wrong, as a VC, I can see it also being competitive to some of the startups I'm putting money into. So
Exactly.
yeah, it's not like I don't see that angle, but I think we all believe that having a large institution, well capitalized, that has the ability to build, buy, and develop that part is good for the whole entire ecosystem. It will make startups have to be more on their toes, have to be more competitive for sure. But there are things startups can do that big companies can't do, and there are things big companies can do that startups can't do.
Yes.
And that will always be the case.
It could spur M&A by Kareem.
It will definitely spur M&A, but I think more importantly, it will continue the entrepreneurial or the innovation in the region with a strong pace. Things like this are motivating for all people.
Okay. Well, I think we've covered a lot in the past nearly hour or so. I want to thank you so much for all the insights that you've shared. It was super helpful. Great to have a conversation with you, Basil.
No, thank you, and thanks for having me. And I love, what you're doing with this and getting the word out and connecting the stories and the insights that you are bringing to market. So, congratulations on everything you're doing, Lulu.
Thank you. Thank you so much for tuning in to this conversation with Basil Moftah. I hope you enjoyed it. To learn more about Conversations with Lulu and to listen to all the other episodes, you can visit conversationswithlulu.com. You can also follow me on all social media platforms at Lulu Khazan. If you want to reach out to me for feedback, for guest recommendations, or for sponsorship requests, you can do so on the website, or you can reach out to me through my email, lulu@conversationswithlulu.com. Don't forget to subscribe wherever you listen to or watch your podcast to get the latest episodes. And if you're enjoying what you're listening to, don't forget to give us a rating and a review and share it with everybody that you think would benefit from this content. I'll see you in a few weeks.